coming, and hell's coming with me, you hear? Hell's coming with me!
Hello, everyone, and welcome to a Hell's Coming edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Serving the Silicon Valley area of California, just south of San Francisco, sort of the South Santa Clara County area. If you're interested in getting anything done in the wide world of real estate in that area, please feel free to give me a call. You can reach out to me at my website, soldbyrobert.com. If you're a newcomer to the show, you can also find the show there. It has its own URL, therebelbroker.com. Or if you go to soldbyrobert.com, there is a link in the menu right to the show, so you can check everything out there. Welcome to it. Welcome to July. I hope everyone had a fantastic 4th of July weekend. I took a couple of days off to celebrate America's birthday. I hope all of you did too. Terrible some of the things that went down with folks, the violence at a parade. That's just so unconscionable, particularly at a time when everyone's getting together to celebrate and kind of come together in their communities. Here in Morgan Hill, it's called California's 4th of July parade. It's a wonderful parade. If you go online and look at it, it's just great. Just families all up and down the street having a good time. It's a shame that a lunatic can come out of the woodwork and wreak havoc on what looks like a great community of folks. And I sure hope everything comes out as well as it can for those folks. But of course, we are focusing on real estate things. And I came across an interesting article from, well, less an article, more a research piece from the folks at Atom. If you want to find out their stuff, you can go to Atom Data, ATTOMDATA.com is the website. They're great for really just data-based stuff. And I find myself either using them directly a lot or discovering that an article I find interesting is using their data for their article. And this month, I wanted to talk about an article they put out just at the end of last month. New Jersey, Illinois, and California have highest concentration of vulnerable housing markets. I think this is key data for you to know for both ends of the spectrum, whether you're a buyer or a seller, an investor, whatever. Knowing this, I think, is a super important piece of the puzzle for you. Because if you are a owner of a property and you own property or live in one of these communities that is seen as highly vulnerable to a downturn, I think it's important for you to know that. It's always going to be smarter. If you've got long-term plans to stay in your property forever, don't worry about it. However, if you do have some concerns or do have some plans that indicate that you should be thinking about moving at some point in the relatively near future, let's say within the next 3 years, I think understanding this data is critically important. If you're an investor in any of these areas, it may be time to pull out your cash, sell these properties off that you've had as an investment, and move that cash to a market that will get you a more reliable payback. So you're not losing your monthly income from investment. You're simply securing the appreciation that you've enjoyed on that investment property. And then, of course, for buyers, these are areas you may want to focus your interests. If you are someone who has the flexibility to live in these communities, or you are someone who's been trying to buy in some of these communities, but you have not been able to historically, the worm has turned in many areas, and this may be an opportunity for you to jump in and acquire a property at a more reasonable price. Of course, the price isn't the price anymore, right? Everyone's talking about what the price is once you add in interest rates and other things. I continue to argue that not going with a variable rate loan still makes lots of sense for a variety of reasons. Check my last, it was either the last Coffee and Real Estate where this came up or the last podcast. I apologize, I can't remember which. But I tell you, with the volatility of interest rates that I'm thinking we're going to see, it just makes far more sense to get yourself a fixed rate loan. I mean, why face that potential increase in your monthly costs when that variable rate mortgage adjusts? And as I said, I think that the smart window of whether or not you get an adjustable rate mortgage or not is very narrow. And I think an adjustable rate mortgage is only smart in a very narrow set of circumstances. So just make sure to understand what those are. Understand the timeline. Understand when that interest rate changes. You won't know what it'll change to, right? Because it's going to be based on whatever the prime rate is down the road. But I just really want you to make those smart, informed decisions so that you're securing your future. There is nothing more comforting than having a fixed cost on your monthly housing and knowing that will not go up. And that's what a fixed rate mortgage is going to give you. And I realize we're at much higher rates, but I think the probability of those rates going down is relatively thin. There are just too many things that need to happen in order for that to be a reality. Now, granted, one thing is if we go into recession, and I believe we will, at some point interest rates will come down, but they'll come down from whatever point inflation was dealt with, right? Because the reason to raise rates is to deal with inflation. And we have inflation because of some really bad monetary policy that's been going on in terms of printing money and these other types of things. So much money has been printed, I don't see interest rates coming down for a very long time. We would have to see the recession hit hard before the decision to lower interest rates would come. And I'm not sure we'll ever see them go back down below 5%, at least in the near future. At some point they will, who knows? The weirder things have happened. But in terms of making decisions today, I don't think looking for those below 5% interest rates is a reasonable expectation moving forward. Okay, so let's jump into this. We're almost 8 minutes in, and we haven't even gotten to the main point here. But I wanted to hit this list because, and I'm going to have a link to it in the show notes. So there'll be a link to the primary show notes page on soldbyrobert.com. If you want to see the show notes, you can go to soldbyrobert.com. You can either go to the podcast section, or on that front page, if you scroll about halfway down, there's going to be a section on the latest podcasts and news that's been published, and it should be the first or second. I know this is also the time of the month when I'm publishing market reports for San Jose, Gilroy, and Morgan Hill, so those will be in that mix as well. So if you just want to see podcast-related stuff, therebelbroker.com is going to be the way to do it. So let's go ahead and jump in and look at this. And one thing as a side note, whenever you're looking at data like this, if you go to the bottom of something like this and it tells you what the methodology was, that is a good thing, right? If someone's laying out exactly how they figured these things out or how they compiled this data, it's always going to give you, I think, a much more reliable feeling for the data that you're getting. And some of the big takeaways from this data, let me just hit a few of the key ones here. One of the first things is most vulnerable counties clustered in the Chicago, New York City, Cleveland, Philadelphia, along with Delaware and parts of California. So there's a pretty good swath of areas. Now, 32 of the 50 U.S. counties most vulnerable in the first quarter of 2022 to housing market troubles were in the metropolitan areas around Chicago. We've got Chicago, Illinois, New York, Cleveland, Ohio, Philadelphia, PA, as well as Delaware and interior California. They included 8 in Chicago and its suburbs: Cook, DeKalb, Kane, Kendall, Lake, McHenry, and Will counties in Illinois, and Lake County, Indiana. 6 in New York City metropolitan area: Bergen, Essex, Ocean, Passaic, Sussex, and Union counties in New Jersey. The 3 in Philadelphia were Philadelphia County plus Camden, Gloucester, counties in New Jersey, while the 3 in the Cleveland area were, I'm going to give this one my best shot, Cuyahoga Lake and Lorain counties in Ohio, Kent County, Dover, Delaware, and Sussex County, Georgetown, Delaware were also among the top 50 most at risk in the first quarter. Now, getting more local to our markets here, California had 10 counties in the top 50 list. Butte County, which is where Chico is, for those of you who go to Chico State or have been to Chico State or know where that is. San Joaquin County, that's the Stockton area. Stockton is an area I've been looking at for multifamilies, and this news is actually music to my ears. I would love to see that market come down a little bit. I've been watching it for 2 years and seeing it go up to levels that I thought were unsustainable, so I did not invest. Shasta County, which is up near Redding, and Solano County outside Sacramento in the northern part of the state. Also Fresno County, Kings County outside Fresno, Madera County outside Fresno, Merced County outside Modesto, and Stanislaus County outside Modesto. In Central California, Kern County near Bakersfield in the southern part of the state. So not a lot to be said about some of the more impacted markets as it relates to increases. Santa Clara County is really the soft, chewy center of crazy markets, right? We saw huge increases in Santa Clara County. The last time we had a downturn, the 2006-7 to 2011-12 time period, Santa Clara County saw plenty of drops, huge drops, particularly at the higher end. But we saw some gigantic drops in sort of peripheral areas of Santa Clara County, like Gilroy, like Morgan Hill, where we had property value drops of 30, 40%, which were crazy. Let's see. Counties most at risk have higher levels of unaffordable housing, underwater mortgages, foreclosures, and unemployment, according to the data. Counties least at risk currently are concentrated in the South, which is really interesting. We've talked a lot on here about areas that were good places to go in terms of likely future stability, good opportunities, not just in terms of what the communities had to offer, but what the price or barrier to entry was for purchasing a property. 26 of the 50 counties least vulnerable to housing market problems from among the 586 included in the first quarter report were in the South. Just 5 were in the Northeast. And that's a direct quote from the article. And here's one I think we share, right? Because we've talked about Tennessee before. Tennessee had 8 of the 50 least at-risk counties, including 5 in the Nashville metropolitan area, Davidson, Rutherford, Sumner, Williamson, and Wilson counties. Virginia also had 5, including 3 in the Washington, D.C. area, Arlington, Fairfax, and Loudoun counties. And Wisconsin also had 4, Brown County, which is Green Bay, Dane County, which is Madison, Eau Claire County, and Winnebago County. Populations relating to the county of at least 500,000 that were among the 50 least at risk included King County, Seattle, Washington, Santa Clara County, my county in San Jose, Middlesex County, Massachusetts, outside Boston, Travis County, which is Austin, Texas, and Hennepin County, Minneapolis, Minnesota. And that's another element for you investors, right? This is less important for buyers, aside from that moment that I strongly suggest you put on your investor's hat, right, when you're buying a home. Population should play a part into your decisions to invest in different areas. And this number of 500,000 in terms of population, I don't think is a bad one. It might be a little higher than I might put it, but it really depends on not just the population. It depends on the makeup of the county overall. You want to figure out if you're investing, particularly if you have a relatively robust population of folks who are going to be able to consistently pay rent. You're going to have renters. You're going to be able to have choice of renters when the time comes for you to find one. Those types of things, and obviously a higher population county is going to be one that's going to feed that need better than a lower population one. Lower levels of underwater mortgages, foreclosure activity, and unemployment in least vulnerable counties Less than 5% of residential mortgages were underwater in the first quarter of 2022, with owners owing more than their properties are worth in 31 of the 50 least at-risk counties. Among those counties, those with the lowest rates among those counties were Williamson County, Tennessee, outside Nashville, 1.5% of mortgages underwater. San Mateo County, outside San Francisco. For those of you that's up the peninsula, at 1.6%. Chittenden County, Burlington, Vermont, 1.7%. Santa Clara County, San Jose, 1.9%. And Travis County, Austin, 1.9%. So these counties, in terms, and this can change. This was one piece of data I thought was interesting, because I think that because so many people have purchased at these higher price points, and I think this is true not just of Santa Clara County in my area and San Mateo County up the peninsula and Travis County in Austin, that any sort of a drop in property values, I think, could represent a huge problem. Now Austin, I think, is a little bit more immune to this than my areas are, simply because of the amount of increase and the crazy dollar amounts we're talking about, for instance, in Santa Clara County. So really, talking about low foreclosure rates or levels of underwater mortgages, I think that becomes a more volatile consideration in a time like this, where we're concerned about a potential flip from properties continuously increasing to them flattening or declining. And remember, not all of these homes were purchased with 20% down. Many were, but some of them were purchased with 3.5% down, 10% down. So what happens when these properties start to approach the levels of being upside down? Now, there'd have to be a pretty dramatic drop in property values. But if we do get hit with a recession, and we've also got inflation at the rate it's currently going, where do we see ourselves going in terms of home values, or at least home prices? I think we're setting the stage for a scenario where we could end up with an awful lot of folks who are upside down in their loans. And we've seen what happens when folks get upside down in their loans. And all that does is feed the beast of a downturn. So that's going to be an interesting one to keep our eyes on. Let's see. The March 2020 unemployment rate was more than 5% in one of the 50 most at-risk counties. The lowest levels among the top 50 counties were in Shelby County, Alabama, outside Birmingham at 1.6%. Chittenden County, Burlington, Vermont at 1.6%. Davis County, Utah, outside Salt Lake City at 1.9%. Limestone County, Alabama, outside Huntsville at 1.9%, and Williamson County, Tennessee, outside Nashville at 1.9%. So this data, I think, if you heard your county in terms of least likely to have a problem, I think that you're in a good place, right? If there are concerns and your county was mentioned at the most at risk, when we hit those at the sort of the top of this, I think it is time for you to start looking around at where you stand. And again, we've talked about different things that should kick off a review of where you are, with your property ownership, with your assets, with how concerned you are about your continuing employment, stability in your life professionally and personally even, right? Should play a part. Use these as a way to start thinking about that. And for those of you who are in California, and there were a few of these, right? We have San Joaquin County and Stockton. We had a few that were much more at risk. I think particularly in these, and you know what really surprises me is that Boise isn't on this list of at-risk markets. We have seen so much increase in property sales in terms of the dollar amount, the average sales price of a home in Boise. I think there's a huge probability that Boise sees underwater mortgages in the near future. It's one of those communities that really stood out. It stood out enough that not only I noticed it, but we actually saw several news outlets mention it. And I think that there is a potential problem relating to folks being underwater in Boise within the next 18 months to 2 years. So I'm going to keep my eye on that one because I also happen to think Boise is a great market. I think there's an awful lot of folks moving to Boise. I have had several folks this year leave California going to Idaho. I had someone I was talking to who didn't end up being my client, but someone who I was talking to who actually moved into a community just west, bordering Boise, basically, a suburb of Boise. I've had folks move to northern Idaho. I've had folks move to Boise proper and the suburbs now of Boise. It is definitely one of the hot places for folks to go. And in some of those areas, I think there's a probability that we will see a drop in values that could be a concern in terms of being upside down on your mortgage. The numbers may not be as dramatic as they are in California, where the average home price is $1.5 million, but you can go to Boise, the suburbs of Boise, and find homes that are in that price range, 1.5 million, 2 million. I've seen quite a few. There was one recently where the price was dropped $150,000 in the Boise marketplace. So, and I'm tending to see price drops more now in Boise than price increases, which tended to be the other way around just a few months ago. And now if you want to, this is a suggestion I made, again, either in the last podcast or in the last Coffee and Real Estate. One quick way to really check and get a feel for what's going on in various markets, go to Realtor.com, enter your city or whatever city you're interested in, and look for the arrows. Look for the green arrows pointing down and the red arrows pointing up. Red arrows pointing up indicate a recent price increase. Green arrows pointing down indicate a recent price decrease. Look for the ratio between those two. Now, there was a time when I could log on to Realtor.com and look at Boise, and there were only red arrows, right? There were only increases in home prices. Today, I see virtually no increases and an unbelievable selection of homes. My screen right now is filled. I'm not seeing a few here and there. I am seeing every part of Boise. You know, usually if you're scrolling way back, you won't only see the dots. But on Realtor.com, you can also select to only show price reduced, and I see them everywhere. They're with only a couple of exceptions. There's one neighborhood. No, there's even, if I zoom in, they're even there. So everywhere. Maybe Maple Grove, Franklin is one, but surrounding that particular neighborhood are a huge number of price decreases. So do that in your area. Get a feeling for what's going on. And then you can go property by property and get a feeling for how much they're dropped. And I suggest whether you're a buyer or investor, you do this. Subscribe to getting email updates on these, and you will get an email that says recent price increases, recent price decreases, and take a look at what happens in those. And at this point, I do this in several markets. I do this in Phoenix. I do this in my local markets. I do it in Morgan Hill, San Jose, Gilroy. I do it in a lot of different markets because I like to get a feel for what's going on. And at some point, you're going to realize, you know what? In the last 2 weeks, I have only gotten emails about decreases. Or in the last 2 weeks, each email I've been getting about decreases has had 10 or 15 properties in it. And the emails about price increases, I've gotten one property listed in that email. It is a great way to sort of get a feel for what's going on in various markets. So I suggest all of you do that. Head on over to Realtor.com and use that as a way to just casually every week, you're going to get these emails and you're going to get a feel for what's going on in terms of the dynamics of pricing for list price. And it's one of the most valuable tools I think you can use. Being calibrated to a local market, I think, is a ridiculously valuable tool that far too many people don't look at. And I suggest you do it now. Let's say you're not thinking about buying right now. Let's say you're thinking about buying in the winter, or let's say the beginning of next year. Start that now. You're going to be able to get a feel for the evolution of the market on how things are changing from subscribing to those kind of things. So hopefully that's a useful tip for you. And we've kind of covered this in the context all throughout of what you should be thinking if you're a buyer, seller, or investor. So I hope that's been useful for you. As I said, there will be a link in the show notes for today's show. So feel free to check it out at soldbyrobert.com or therebelbroker.com and go over the data yourself. See what you think. There's also some hard data included in there, but right now we just sort of went through the various counties because I wanted you to key in on those counties either because you're in them and this may have a direct effect on you, or you're near enough to some of these counties that it might spell an opportunity for you for investment, right? Particularly for those ones where the markets are likely to go down in those areas. So keep an eye on that. All right, folks. As always, the goal is to leave more value on the table than we take up on your time. Hope we've accomplished that today. Again, hope you had a fantastic 4th of July. Thanks again for listening. I'll talk to y'all next time.